All right, everyone. Well, thank you for joining us again on another edition of our Friday webinar series on the Franchise Your Business podcast and webinar series that we've been hosting here for the last several years. And as everyone is loading in, just as a quick housekeeping item here, I'd just like to remind you, if you have not had a moment to subscribe to either of our podcasts, we'd encourage you to do so. That is the Multiply Your Success podcast and our Franchise Your Business podcast. And if you're not sure about either podcast services, check us out on our YouTube channel, bigskyfranchiseteam.com. We will have this recording live. And please, please, please make sure you share this, because this content specifically for today's episode is some of the most critical and important information in franchising that we've had to share in a long time. And our guest today is Edith Wiseman, and I followed and been around and watching Edith for many years in franchising. She's been the President of FRANdata, and has been with she is the president, I should say, of FRANdata, and has been with the organization for more than 15 years now. She has been highlighted in the Franchise Times magazine as a rising star in franchising and entrepreneurs' top influential women in franchising. She has long been a key figure in understanding and promoting business model excellence and franchise finance best practices. Edith currently sits on the International Franchise Association Foundation board and is also past chair of the IFA's Supplier Forum and former chair of the IFA board. She remains a strong advocate for emerging brands through her work with the Emerging Franchisor Conference Committee and the Emerging Franchisor Task Force. Edith is also an active member of the America West Lenders Conference Committee. So needless to say, she is an absolute expert in this area and is passionate about helping emerging brands. And it's something that we share in common. And with that, Edith, I'd love to just turn things over to you to share some of this information.
Yeah, thank you so much, Tom. So I tell people that I have one foot in franchising and the other foot is in lending. So this topic of franchise lending is very near and dear to my heart. So what I want to do today is let's learn about SBA franchise lending. There's a lot going on, so you need to pay attention as changes have been occurring. So what I plan to do today is first just give you a primer on SBA lending. I think a lot of people don't fundamentally understand how it functions. And so, the pinpointing of like who's responsible for what gets cleared up when you understand what the program is. Then I want to bring you into the psyche of an SBA lender. It's a dangerous place to be. No, just kidding. But I just want you to understand how they think. It's unique. It's different than a conventional lender or equipment lender. They have a distinct way of thinking. I'm going to go over the changed rules. So SBA released 2 rules. We're going to go over what those changes are, and then how you can ensure the best outcomes for your franchise system. So let's get started. What is the SBA 7A loan program? The easiest way for you to understand what it is it's an insurance program. So SBA, the federal agency, does not actually make loans. So whenever someone says to you, oh, the SBA said this, they're not willing to do my deal. It's a little bit of a misunderstanding. 7A is the backstop for lenders who are making small business loans to your franchisees. And for that, lenders who do that, they get a government guarantee between 50 to 90%. It changes depending upon the program and if there's any incentives. Historically, it has not been federally appropriated funding. So it is literally the fees that lenders and borrowers pay is what backstops the program, not taxpayer dollars, unless there's a financial crisis and then there's too many defaults in the portfolio. And then many of the SBA lenders, when they finance your franchisee, they're likely selling it off into the secondary market so that they can then make a premium on that sale, have funds to sell back into to be able to make more loans. That's just an important point because loan structures will vary based on whether or not the bank you're dealing with or the bank your franchisee is dealing with is a bank that sells or holds. There are different structures that will occur. So what does this guarantee let banks do? It lets them lend to businesses they otherwise wouldn't, lend nationwide. You can take a small little bank who, traditionally could only finance right in their market. And now all of a sudden they've got an SBA license. They can finance small businesses nationwide. They can lend more because they're selling it on the secondary markets. And they can also develop concentrations in like a brand or an industry that might otherwise they wouldn't be able to without this guarantee, this federal guarantee. So that's the primer. So let's get into SBA lenders, and when I say that, it encompasses more than just like a person. It encompasses an institution, all the people within it. So SBA lenders are rule followers, right? So SBA says here, follow our rules, and then you will get the guarantee. If you don't follow these rules, you won't get the guarantee. So what does that mean? Follow the rules. Okay, so there's a standard operating procedure, SOP, that lenders have, and it's hundreds of pages long. Now that SOP changes every year. So lenders have to know what are the current rules, and they have to make sure they keep track of what the old rules were, because the old loans were subject to old rules. I'd like you to consider, how often do you think political appointees change? How long does it actually take someone to understand franchising? There's an association for SBA lenders, just like there's an association for the franchise community. That association has classes to train lenders on how do you do SBA lending. Do you know how many notices that are issued by SBA? So the SBA puts out an SOP, but then throughout the year, they might send out like, oh, here's a technical update. Oh, here's a notice of this is what we mean by that. So lenders have to make sure that they're keeping track of all of these changes and interpretations of the rules, because sometimes the rules are a little bit gray. And there is a technical issues committee within the government guaranteed association to talk about these gray areas. How should we be dealing with this? Oh, I got a notice from SBA that we can't do this, but then some other SBA person told me I could do this. So my point is that there's a lot of rules. Some of those rules are ambiguous and up for interpretation, and they're constantly changing. So what do lenders fear? They fear losing the guarantee if they don't follow the rules. Newsflash, SBA is getting out of the effing business, the franchising business. They're getting out of it for many reasons. One is because they feel like a franchise business is just the same as a small business. So why are we treating franchising differently? Secondly, they're getting out of it because their whole objective of creating new rules is to simplify all these rules. They're saying there's too many rules. You know what? We just want you lenders to do more loans. We want you to lend to more small businesses, and we want you to do it in a simplified fashion. Now, I skipped over one slide. So there were two rules that were recently just implemented. So August 1st was the first day of implementation for the affiliation lending criteria rule. And then there's the small business lending company, SBLC, moratorium, rescission, and removal of the requirement for loan authorization. That's a mouthful. I'll go through what, like, big picture, what these rules mean in just a moment. Okay, so before I go into that, I just want you to get some visibility into how SBA lenders are reacting to this new rule. So I talked about if they follow the rules, but what happens if those rules become even less clear, muddier? So what we're seeing a reaction, and this is, I took these quotes here straight from LinkedIn. So I've got a whole bunch of lenders that I'm LinkedIn with, so I get to see what they're saying in addition to I talk to them, but these are all taken straight from LinkedIn. So one was the SBA world has turned a bit upside down. So that's a post that I actually reshared because I thought that was useful for people to see. Then another lender said, the loss of the franchise directory, bring it back, SBA. So there's concern like, oh goodness, this is going to be a problem for us. We're trying our best to bring some sanity to the craziness that is in my industry right now, meaning the SBA industry. Then the last is you can ask 10 SBA lenders the same question and get 10 different answers. Okay, that's really helpful. So what do each of these rules do? So I'm going to go through like the highlights of the rules and what it means. And then a little later, we're going to go back to this chart and say, what do these rules do and what can you do about it? Okay, so what do the rules do? Number one, it eliminates 9 pages of franchise affiliation. So I'm zeroing in things that are really like most important to franchising. So in some respects, that's like, hey, Ray, that's less regulation, right? So fewer hurdles to jump over, the better. So that's something that I think we can all get excited about. The second is that it eliminates tracking franchise loan performance. So historically, SBA has published just data on SBA, and they've tracked loans performance by franchise. Actually, they used to, then they got out of the business, they got back into the business. And there are third-party companies who sell this SBA data on an aggregated form, and SBA lenders made decisions off of it because they said, oh, well, if SBA's loan portfolio shows that there's a 50% default risk, like, I don't want to lend to that. So I think in some respects, what is really important for you to know is that data has always been flawed. And so it's given people a bad picture, or lenders a bad picture about certain franchises that were not true. So we have historically cleaned up that SBA data, found loans that were missing from that portfolio that completely changed the picture. So like in some respects, you're like, that's great. Bad data is not good data. And just because it's there doesn't mean people should be using it. But it means that lenders will need to fill that gap. And what we've seen is lenders are absolutely using another source called the Fund Score on franchise brands to assess the loan performance relative to a franchise system or predicting success. The second is it completely eliminates the franchise directory. So previously, the SBA, in order for a franchisee to get a loan, the SBA said, lender, you may not lend to a franchise that is not listed on the directory, that has been vetted by SBA for affiliation as well as eligibility. So that means that, yay, affiliation's gone. Boo. Eligibility review has been gone. So it puts the risk and the onus on the lender to determine eligibility. But SBA believes like, hey, lender, that's your job. It's always been your job. So why can't you do it with franchises? Franchising is different. So we'll get to why, like how franchising is different in just a moment. But what the rule also does is it tells lenders that they're no longer getting guidance from SBA on lending criteria. And it also changes the definition of a small loan from $350,000 to $500,000. So what this means is they say these words, lender, do what you do. We're like, there's thousands of lenders. We all do something different. So there's confusion. Like lenders like rules. We just took away some rules. Now I've got to go figure out, like, do what my conventional practice does, but they don't lend to high-risk small businesses. So how am I supposed to adjust to this? And it also means more credit scoring. So there's going to be a need for speed, because if more loans can be credit scored, that's great, but it means that we need to have fewer hurdles in the process, because the whole value proposition is to be able to do these loans quickly, smaller loans quicker. And it also opens up the program to fintechs. So previously, the SBA only had 14 non-bank lenders. Now there is no limitation on non-federally regulated institutions to offer SBA loans. So what that could mean is more lenders to the program, but there's concern that it's lenders that are not federally regulated. And does SBA actually have the bandwidth to regulate fintechs? So what is helpful for people to understand is like, what's the difference between affiliation and eligibility? So affiliation, what SBA was vetting for, that is now gone, was just making sure that the franchisor and the franchisee weren't actually co-joined as a big business. So the SBA vetted the franchise agreements to say that it's not overly controlling that would make them connected. So that concept is gone. Nobody cares who controls who. But eligibility, which is the rules of SBA, who you can and can't lend to, there's a whole set of rules. So I'm going to give you some examples that are in the franchise world. So in order to become eligible, a brand called Children's Lighthouse, they're a early childhood education, they had to change their curriculum because it was actually, SBA thought the curriculum had some religious overtones, and you can't have anything religious related to getting federally guaranteed loans. Vitamin Shop, they sell CBD products, and CBD isn't legal. So that's a problem. So they had to fix something in order to say that to get SBA approved. Sola Salons, they're a salon suites business. They're defined by SBA as a passive business because they rent rooms. Home investors, they consider a speculative business because they're selling houses where they're trying to buy houses to then flip them and sell them. Hooters, they have discriminatory hiring practices according to SBA. These are different rules. There's about, as far as we can identify, like 30 something rules or things that franchisors need to like overcome in order to be eligible. So what's the reaction in Congress? SBA, who's their boss? Congress, the House Small Business Committee and the Senate Small Business Committee. Well, I'll tell you, in the House Small Business Committee, I took these quotes directly from their press releases. They consider these the most significant changes to the program in decades. Changes to the lending criteria will add more risk to the taxpayer-backed loan portfolio. These changes will lead to greater default rate. Chairman Ben Cardin says, we know that the administration issued their rules. We had certain concern with those rules. We also recognize that it was our responsibility to legislate. And if we don't legislate, we're going to see more of these rules come out. So guess what? The Senate Small Business passed legislation July 20th, essentially rolling back most of these SBA changes. Now, it hasn't passed. It hasn't come to law. Like that might take some time, but it tells you not happy. SBA is not happy. I'm sorry, the Congress is not happy with SBA. So, well, how are lenders reacting? Okay, this is there's a lot of words on this page, so I'm just going to pick one of these. So basically, the SBA franchise changes have taken the express out of the SBA express lending without the franchise registry. Given the SBA franchise rule changes, I find the registry, franchise registry, and the team at the franchise registry even more valuable today than ever before because we have greater risk in the franchise lending process. All franchisors should have a membership in the franchise registry because it speeds up the financing process for franchisees and gives us greater confidence in the deal. There's more there, and you can read them. I won't bore you, but the whole point of this is lenders unanimously are saying, we need help. We can't do this on our own. And guess who they're turning to? So here what I have is a picture of just today. I grabbed today. This is FRANdata's internal management system, and it shows you the lenders that have logged into the franchise registry to pull down information on different brands. So let's see these brands. Some of them you've probably heard of, some you haven't. Zoop's, West Coast Sourdough, never heard of it. Wingate, Postnet, Subway, We Rock the Spectrum, Dry Bar, Tapioca Lounge, Dry Bar, Serve Pro, Ziggy's Coffee, Milkshake Factory, nectar juice bar, tropical smoothie. Okay, I've bored you. The point is that just this morning, and I grabbed this early this morning, these are the lenders who are logging in and getting information on those franchise brands. So who are these lenders? So as I mentioned, when we talk about lenders, we're not just talking about one person, like a business development officer. We're also talking about SBA eligibility officers. Do you know there's actually a person whose job it is to determine eligibility, right? We talked about affiliation versus eligibility. That's how important it is. That's how important eligibility is. Then you've got closers, underwriters, business development executives, risk management. All of those people have access to the franchise registry to be able to get information about a franchise brand to make the lending process smooth. So how do you take control? Congress doesn't like these rules. SBA lenders don't like these rules. And how do you take control? So let's look at each of what the rules do and what can you do? So eliminates 9 pages of franchise affiliation. What do? Cheer. Yay. It eliminates tracking franchise loan performance. What do? If you are a brand that has been franchising for 5 or more years or has 50 units or more, you're going to want to review your fund score, which is your franchise credit risk rating that lenders use to evaluate your franchise performance. If you have a high fund score, then guess what? You get better terms. You actually get faster loan processing. It's amazing. I have a franchisor who told me that they received prime minus because of their fund score. Prime minus, that's ridiculous. And also consider a report that is produced to help lenders get to a yes that evaluates your risk against comparable franchise companies. Eliminate the franchise directory. Become a franchise registry member and agree to sign the certification, which I'll tell you about in just a moment. Puts the onus of risk on determining eligibility onto the lender. Be a franchise registry member and agree to sign the certification. Tells lenders they are no longer getting guidance from SBA for lending criteria. What can you do? Ask each lender how their credit process and risk has changed since the rule changes. So you want to ask them things like their equity injection, the paperwork they're using. So how have these rules changed how they're doing business? That way, you know, for that particular lender, how they're reacting. Because as we heard before from what lenders say, ask 10 different lenders, get 10 different answers, that you will get a different answer based on the lender you're talking to. If your franchisee's capital needs are less than $500,000, you want to talk to the folks at FRANdata and the franchise registry about how you can provide the information for borrowers to be credit scored so that you have a faster loan processing for your franchisees and you are getting your royalty dollars sooner than you would otherwise. And opening up the program to fintechs, it may provide additional lenders that are focused on credit scoring for fast processing. So I mentioned the franchise registry a couple of times. It might be a new concept to you. It might be something that you're familiar with, but as we saw, go to the franchise registry to get access to franchise information. And FRANdata has created a certification that addresses all of the eligibility issues, all of the known eligibility issues. So if you are a franchise registry member, you will get the certification that you can agree to sign for any lender, which lowers the lender's risk to doing franchise loans. So essentially what it's going to do is going to save time to getting to the franchisee getting financing. And it's also going to save your franchisee and you as the franchisor money to getting the deal done. Because if the SBA lender chooses an alternative path, it will increase your cost and time. As part of the franchise registry, a franchisor gets to understand their creditworthiness and how to improve their creditworthiness and get connected to financing institutions and know which banks are evaluating your brand. So you saw all those lenders and all those brands. So we actually get to see what lenders are downloading what information. Really helpful insights. So without the franchise registry, what can you expect? You're going to get treated differently by different lenders. Because some lenders are going to send out the franchise agreements to lawyers, which will cost the borrower money. And guess what? If you get different interpretations from different lawyers, it's going to cost you more time and money too. A lender might send the franchise information to SBA. So every lender has the option to do it themselves, or to say, hey, SBA, we want you to weigh in and help us and just decide, tell us whether it's eligible or not. And so they send it into this central processing center, and then they have to wait and wait and wait. So you are going into a black hole. I mean, the SBA is known for like screen out letters. So a lender sends in a package and then get a screen out. You need to provide X, Y, and Z. Okay, so now it's been screened out. Guess where you go when the lender responds to that? To the bottom of the pile. So if you are someone who had a busy day and you needed to get hanging out with your children, what do you think you'd do with all the loans in your pile? Screen out, screen out, screen out, screen out, screen out. I'm not saying anybody does that. I'm just saying it's possible. One of the things you could expect is increased mistrust between lenders and franchisors right before the rule changes were coming down the pike. I was getting text messages from a lender where the franchisor wasn't agreeing to sign the franchise documents before the loan closed, and essentially the franchisor said, well, SBA is getting out of business, so we can do whatever we want. So there is this sense of, oh my gosh, now franchisors it's going to be a wild, wild west. They're going to put random things in their documents that they weren't allowed to before. And so there's concern. And new brands and smaller dollar loans will be affected the most with these changes. The reason for this is because new brands haven't been vetted. Older brands have been vetted as long as they were on the franchise directory. So the concern is just like, okay, well, what was eligible versus what was affiliation, and has the franchisor changed anything? With new brands, there's just no precedent. And then also when it comes to small dollar loans, who has time or money to get these things reviewed, right? Like a small dollar loan costs just as much as the large loan, and now we're just adding on time and cost. So it doesn't make it attractive for the lender to spend any time on a small dollar loan unless they have certainty. So last but not least is I mentioned the fund score. This is a franchise credit risk rating, and this tells a lender what does it mean for the creditworthiness of the brand. So if we look at on the left side, a lender's risk assessment, the top tier is low default rate risk, a 750 to 950 credit score, very similar to a FICO. What this means for your franchisees is that the lenders are going to give fixed rate financing, low equity in payments, and easier process. And you go down the line, and essentially every lender has a different cutoff point where they say, not going to lend below fill in the blank. There may be exceptions to the rule for specific outstanding borrowers or really strong packages. But for the most part, a lot of lenders have drawn lines. So I would encourage you to find out what your credit score is and see if there's a way to improve it. This is not unlike your personal credit score, where there may be something very simple that is bringing down the credit score, or it could be more complicated, something that takes a little more time to work through. So all in all, the most important thing when you're talking about a time of change, so there's SBA changed their rules. There's talk about new changes possibly coming down the pipe, reverting back to the old way, is that you have to provide some level of consistency for your lenders and to ensure that your franchisees won't get caught in this, not every lender not knowing what to do and having a different process to deal with these changes. So the way you can do that for your franchisees in the franchise system is to rely on the franchise lending experts and those who have 8,000 plus lenders who come to our site to get access to information and to ease the process with the certification. So happy to open up the conversation now to any questions, Tom, from you or anybody else.
Yeah, absolutely. Thank you, Edith. Great presentation. Thank you for sharing that. And anyone who's tuning in, please feel free to type any questions into the chat or just hit the raise hand feature and I can unmute you so you can go ahead and ask Edith directly. While we're waiting for folks to do that, a question for you related to, especially for that emerging brand. One of the things that caught my eye and learning about this and wanting to have you on to speak about this is that if you have not been part of the franchise registry in the past, and I know you were just kind of talking about that, but what does that actually mean for a new emerging franchise brand, or maybe a brand that has 5, 10 franchises that's now starting to take franchise sales more seriously and seeking SBA loans that hadn't joined the franchise registry yet? How does this complicate it? What does that mean?
Sure. So I just want to make a distinction. So there's the franchise directory, which was SBA's directory. And then there's the franchise registry, which is FRANdata's. So with the SBA's franchise directory going away, and a new brand or an emerging brand who hasn't gone through the process to have gotten approved to be listed on that franchise directory, what that means is that the lender has no kind of historical precedent to say, well, SBA approved it, right? So there's security in saying, oh, there's always security in being like somebody else is responsible, right? So SBA was taking the responsibility for that franchise to be eligible and to not be affiliated. And if an emerging brand or a new brand hasn't been on the SBA's franchise directory, then the lender has no precedent. So that's where what the franchise registry has done is, because we've been involved in SBA financing for 20 something years, and we actually used to be the entity that did these reviews on behalf of the SBA. So we would pre-approve brands for eligibility and affiliation. So we have an expertise here. So we're able to aggregate all the issues into one certificate so that then a new brand can actually take this certificate, review it with their attorney, of course, and then sign it and give it to the lender so that the lender doesn't have to go through the rigmarole of trying to determine whether the brand is eligible. And if the brand can't sign it, then there's another path to determine whether the issue that they can't sign can be overcome.
Great. That's very, very helpful. So, and just seeing franchise sales and transactions occur. If you have not been on either the SBA directory in the past or on the franchise registry with the lender and trying to go through that process without it, it lengthens the whole process. I mean, and in my experience has been at least adding an extra 45 days minimum, if not 3 or 4 months, 5 months before it actually goes through. So it really does add a complication to it. So just my experience has been that being a part of the registry and going through this process really helps streamline it, especially when working with new lenders for emerging brands or just really any brand going through this process.
Yeah, it's brutal.
Yeah. Well, Edith, how can people get in touch with you or FRANdata to be talking about getting signed up for or participating in your franchise registry program and getting their franchise listed if they're not? Or maybe they're a franchisor and they're just wondering, am I listed? And how do I double check?
Yeah, so please contact us. You can go to franchiseregistry.com, or you can email franchiseregistry@frandata.com, or you can go to frandata.com and fill out the contact us form, or you can just give us a call. We want to talk to you. So, and please feel free to follow us on LinkedIn, frandata.com. We're doing all sorts of franchise bloopers to show you what we're finding in our research, little fun bloopers, and also good insights about what's going on in this SBA land as things are in a state of potential flux.
Great. Well, and then how would you also recommend, or is there a place that they could go to get updates from FRANdata on the information that's coming out? For example, you talked about the Senate passing, getting some legislation going, and certainly that's going to have some impact. I mean, that was just, it looks like 2 weeks ago that legislation is getting started, and all the stuff that happens in Congress, and it takes a while to get through. So how can they gather that kind of information from you? Where can they go?
So if you're a franchise registry member, we are constantly sending out news updates. So because we're so ingrained in this world, we go to the SBA conferences, we go to NAGL, we go to NADCO, we go to the, I think there's probably 10 different lender conferences that we go to, all the AGLs, NITAGL, HUTAGL, FLAGL. So all of the Association of Government Guaranteed Lenders, we're there. So we are on top of the changes. Plus, we talk to lenders every single day. So if they're hearing something before it's getting to these conferences, then we're going to hear about it. So we actually told our members far in advance of anybody else knowing that we thought something was coming down the pike with these rules, and that there was going to be change to how SBA treated franchising. So we take our role in this process very seriously, and we are updating our franchise registry members regularly about any changes that are going to affect, even when that's changes in credit perception of lenders. So how lenders are now looking at credit. So for instance, banking crisis, how are lenders adjusting? So we're getting that real-time information and sharing it.
Great. Wonderful. Well, Edith, this has been fantastic information. And for those of you tuning in who maybe joined a little late, we will be rebroadcasting this up on our YouTube channel as well as on our podcast site. So if you'd like to share this with anyone who maybe missed this, or you think this would be a great session to share, which by the way, this is a great session to be sharing with people, especially your franchise sales team, franchise marketing, franchise leaders, executives. They need to know about what's going on here, because this is going to be impacting your franchise system and franchise growth. So you need to be sharing this information so that they are aware. So please, please, please pass this along. Edith, I cannot thank you enough for your time on a Friday afternoon. Thank you so much for being here. We greatly appreciate it.
Thank you, Tom. It's been my pleasure.
All right, everyone. Thanks for tuning in, and have a great weekend.